The telegraph produced Western Union and Reuters. The railway boom produced giants such as the Pennsylvania Railroad and Canadian Pacific. Some of these disappeared or were nationalized, but parts of the old Pennsylvania Railroad system eventually found their way into companies like Conrail and Norfolk Southern and CSX. Radio brought us Radio Corporation of America, or RCA as it was better known, television, CBS and NBC, cars, Ford, General Motors, biotech, Genentech, Amgen. The World Wide Web produced Yahoo and Amazon. Then we had the internet as we know it today with companies like Facebook and Google. And we now got the bubble, if it is a bubble, in artificial intelligence. And we don't know who the winners will be. They could be companies like Nvidia or Microsoft. But what I can say about every bubble in history is, whilst there were some winners, many other companies fell by the wayside. Many of the companies that investors loved during the bubble disappeared, went bankrupt, or never justified the prices that investors were willing to pay. You might remember names like Pets.com, Webvan, WorldCom, Global Crossing, Polaroid, Kodak. Where are these companies now? The question for investors in AI and the associated stocks is how many of the companies that we're investing in today will still be in that business years from now. Yes, there's going to be winners emerging, but along the wayside, some of these companies are going to enter the stock market graveyard. As a collection, I think that investors are pricing in too much growth and too little competition. I'm going to tell you why I think that later on. Let's look at the dot-com bubble in the 1990s. Stocks went to the moon, but when the bubble crashed in March 2000 and Nasdaq started going down, many of the companies which had come to market with nothing more than the word .com at the end of their name and a promise that they were going to change the world, many of them ceased to exist. There were a few who survived, but even the survivors fell very, very heavily from March 2000 for the next 3 years. As an example, let's take Amazon. They fell 80 or 90% in the next few years after the bubble popped. Yet they are one of the survivors. How many companies existed then and have completely gone by the wayside? Were stocks in a bubble from the late 1990s through to March 2000? The answer is unequivocally yes. Stocks crashed in 2000, and what followed is now known as the lost decade for the S&P 500. The S&P 500 is currently trading at about 26 times earnings on a trailing basis. That's not cheap. The long-term historical average is in the mid to high teens. So let's call it 16 times, 17 times earnings. We're at 26 times earnings now. So the US market is not cheap. It's expensive. The technology sector is more expensive still. The S&P 500 information technology sector is currently priced at 36 times trailing earnings. The forward price earnings ratio is lower thanks to the growth forecasts for the earnings. But that's the real point. Growth in those earnings have to arrive to justify today's valuations. I am certainly not suggesting that today's market is an exact repeat of March 2000. History almost never repeats itself neatly. The businesses that we're looking at today are much stronger. Companies like Microsoft, Apple, Nvidia, Meta, Amazon, and so on Alphabet have real revenues. They've got real profits and they have strong market positions, at least in their monopoly areas. And that's very different from many of the dot-com companies which came out in the years 1999 and 2000. But I will say this. Valuations are high enough that there's very little room for disappointment. If AI delivers everything that investors are hoping for, those valuations might be justified. But if growth slows, if competition increases, if margins come under pressure, or if investors simply decide that they don't want to pay 40 or 50 times earnings, there's a real danger that prices will come under pressure. Share prices could fall very sharply. The danger is not that AI is fake. It's not fake. It's going to change the world significantly. The technology is not unimportant. It is important. The danger is that investors are placing too high a valuation on the future growth prospects for these companies, many of whom will find themselves in great competition with each other, are not going into an area where on day one they have a moat. They probably don't have any moat, and the end user is going to be very fickle. He's going to be choosing the one which suits him best. So which of the AI companies do you think will be the winner? Well, the answer is you can't tell. It's already a very crowded space, and it's going to get more crowded with time. So determining who the winner is today is very hard. I can illustrate that by going back to the time before Google existed as a search engine. Before we had Google, we had a whole host of search engines who were all fighting it out to be the winner in the search engine space. There was Alta Vista, Yahoo, Lycos, Excite, Infoseek, Webcrawler, Hotbot, Ask Jeeves, and probably loads of others. Which one of those was the winner? Well, the answer is not one of them, because eventually Google arrived to compete with them, and Google won on its own by not putting too many ads on the page. Why did Google win? It gave the users a cleaner, faster, and more relevant answer. The same thing's going to happen in the AI industry. We don't know which of the companies around today is going to achieve that goal, or which future company that you never heard of will get there. The point I'm making is they can't all be the winner, or winners if there's more than one. There'll only be a small number who'll make it and become the user choice. The rest of them will have spent their billions, their tens of billions, in some cases perhaps hundreds of billions, on training their software, on data centers, on buying NVIDIA chips and other things for no result. They won't be the winner. And so, of course, they can sell that technology on, and they can sell their data centers, they can sell their chips to other AI companies, but it means that the growth that they were hoping for, the growth that the investors are pricing into the shares today, for most of these companies, won't be there in the way that investors are actually hoping at the moment. And when you stop pricing in future growth, the share price comes down to a much lower multiple.
Are we in a bubble? Clive Thompson says yes, we're in AI bubble territory, but it's not 1999 yet. We could still go higher. Valuations are high. S&P at 26 times earnings versus historical 16 to 17 times. Tech sector at 36 times. The danger isn't that AI is fake, it's that investors are pricing every company as if they'll all be winners. They can't all be winners. Clive is slowly exiting tech, raising cash, diversifying globally, buying gold, and looking for high dividend stocks. He's not selling everything, he's preparing. History says bubbles pop. Be ready.
I said that I'd tell you about the stock market crash of 1987, otherwise known as Black Monday. That Black Monday was Monday, 19th of October, 1987. The rout in stocks had started a couple of days earlier on Thursday the 15th, and it continued into Friday the 16th. And then Monday was the big day down, when markets around the world suffered an extraordinary fall. In the USA, the Dow Jones fell 22.6% in one day, and some overseas markets fell even more. What was the backdrop to that? Well, stocks had been rising rapidly. Things had become very speculative, I suppose, in the market. The USA had announced a trade deficit record, and the argument with Iran was continuing. We were also in a situation of rising interest rates, but the dollar itself was falling. Nevertheless, the stock market was very buoyant, and companies were reporting very high or large profit growth. So lots of good reports from companies. The rout in selling stock started on Thursday the 15th and continued into Friday. However, there was a problem on Friday in London. London was hit by the Great Storm of 1987, which paralyzed transport and left many brokers unable to get into the city, which basically meant that many people couldn't get into London, almost nobody, because the trains were all blocked by fallen trees, the electricity wires were down, the motorways were closed due to fallen trees. Now, the problem with that was that the faxes were coming into London from all around the world, from Tokyo, from Hong Kong, from Seoul, and other places in the world, where investors were saying, quick, sell all my stocks before New York opens this Friday evening. But London was empty. The brokers' offices were empty. The London Stock Exchange was as good as closed. The London stock market's quotation systems were impaired because many market makers were absent or literally unwilling to quote prices. But most people just couldn't get to work due to the storm. The consequence of that was the stocks which were supposed to be sold before New York opened weren't actually sold because there was nobody to sell them. So when New York finally opened, all hell broke loose. That's on the Friday. On Friday, October 16th, 1987, the Dow Jones Industrial Average fell by a whopping 4.6% in one day, 108 points on the Dow. That was an enormous fall. The S&P 500 fared even worse, falling 5.16% on that day. Most of the fall in New York came after European markets were closed, and certainly after all the Asian markets had closed hours before. So the full impact of New York's fall wasn't seen on world markets until the following Monday. That's Black Monday. Friday's fall set up for the biggest crash ever on Monday morning. That crash massively exceeded all of the crashes that had been seen before in history, including the 1929 stock market crash. I'm showing you here the papers from Tuesday morning, Tuesday the 20th of October, which are reporting about the crash on Monday, October 19th, 1987. That's the Tribune de Genève in Geneva, and one of the French newspapers. The panic selling on Monday was so extreme that they even shut the Hong Kong market completely. And around the world, on the next day, that's the Tuesday, the falls continued, with London down another 12%, Tokyo down 14%, Australia down 25%. If there was one bright spot in the rout, it was gold. Gold was one of the few bright spots in the panic. It spiked up, although the move was volatile and it didn't go straight up. And traders started speculating that we might even see a price of $500 an ounce for gold. About a week before the crash, gold had been trading at around $450 an ounce. But as the crash unfolded on 20th October, it peaked out on that day at $481.60, but ended up closing at $464.30. However, the predictions of $500 gold were not wrong. Within a couple of months, in early December, the gold price passed through $500, reaching $502.75. And what did the clients do on that day? Well, I had 2 telephone calls on that day or around that time. I can't actually remember if it was the day of the crash, the day before the crash, or the day after. But bearing in mind that crash was Thursday, Friday, Monday, and Tuesday. It was one of those days. One of my clients called me up and said, Clive, it's the end of the world. Sell everything. And I picked up the phone to the brokers that we normally dealt with, but they were in London, and because of the storm in London, nobody was at work, so there was no answer. So I guess that would have been the Friday, now I think about that. And then the other client, perhaps he called me on Monday or Tuesday, I'm not sure now. He said, Clive, buy. I said, well, buy what? Anything. I said, well, you've got to tell me what to buy. No, Clive, I don't care. Just buy everything. Put everything I've got into money, into stocks. And we then had a bit of an awkward conversation while I tried to agree with him which stocks to buy, because I didn't want to randomly buy stuff that he didn't want. In the end, we agreed to buy some well-known blue chips. I can't remember which ones they were. Having said that, the guy who sold, his shares weren't sold on the day he wanted them to be sold, which was a bit of a pity, because that he wanted them sold perhaps on the Friday. London being closed, they couldn't be sold on the Friday, so his order fell through to the Monday, which was the worst day ever, and he ended up getting, I would say, rather bad prices due to his panic. And to my knowledge, he never went back into the stock market again. So the stock market after the crash started climbing very rapidly. We'll talk about that in a minute. But the other client who bought things did very well. What happened after the Black Monday was very interesting. The crash itself was terrifying, but it didn't lead to another Great Depression. The Dow Jones fell 22.6% on that Monday, but then it recovered more than half of that loss within just 2 trading sessions. And by the end of 1987, the Dow was well above the Black Monday closing level. And by the end of 1988, 1 year later, it was some 25% above the panic bottom. They can be dangerous if you're forced to sell, but there can be opportunities if you have liquidity. And this is why I'm telling people now they need to raise a bit of cash in case there's an opportunity like this arises. You want to be like the client who said to me, buy anything.